All right, let's kick off with this Foundations First webinar, the investment perspectives on energy's decisive moments. We have a very exciting perspective to share with you, which is really around the fundamentals driving the energy transition. And we have two incredible investors that will help us translate that into, okay, great, all these big trends, but what does it mean for investing today? I'm Lisa. I'm one of the co-founders of Carbon Equity. I'm our climate impact lead. And so bridging that disparity is what I do every day. For today, what to expect. We're gonna talk about the bigger story. Where's the transition at today, which is already quite different from where it was a few years ago, and also where is it heading? What is really driving the transition? And then how do you actually invest into it? Taking a bit of a European lens there, different stages, earlier, later, really translating it into what does it mean right now. And we have many exciting people here, and we would love to also hear your views in this webinar. So please feel free to introduce yourself in the chat if you want to. And if you have a question to us, please ask it in the Q&A section, and we'll make sure to monitor and also capture those questions as we go. Now, in terms of the agenda, we'll first introduce the speakers that we have, then we'll have a brief presentation by Dan on this electrotech revolution, and then we're going into the panel. The Q&A here is at the end, but really want to make it dynamic, so feel free to pitch in. Very briefly in Carbon Equity, we're not going to dive into our own funds, but just for the people who maybe not have heard about us before, we make it easy to put your capital towards climate tech, which we think is hugely exciting and hugely impactful. We do that by building fund of funds, due to which you can invest with a lower minimum, right now starting 20,000 euros. But we also create a lot of diversification. And we do that by working with the best funds in the world, two of which are in the webinar today. These are people who really know their stuff on the sections that they focus on in the transition. And so that way we think you're working with the best experts and you're getting most diversification. We started this program 4 years ago. We have 330 million under management from almost 1,500 investors. So far, built relationships with 28 managers and indirectly have helped fund 250 companies. Now, just again, very briefly for the people who are new to climate tech, this is not a niche. This is mostly the entire, more or less the entire economy. We're talking about the transition of energy, but also of mobility of goods and people, everything that we make and how we make it, everything on buildings, how we build them, but also how we power them and heat them, everything that we eat. And then we're actually building a new sector in the carbon capture and removal to round it all off. So yeah, I'll leave it there for now for the bigger picture and moving on to our panel because we have three great speakers with us. Helmer, can I ask you to introduce yourself and very briefly why you invest in climate tech?
Okay. Thanks for having me, Lisa. So my name is Helmer. I'm an engineer by trade, started as a consultant in energy and built two companies in energy myself, one in biomass, one in online sales of solar panels. And since 2015, I'm the partner responsible for what we call planet investments at Rubio Impact Ventures. So we are an early stage investor, seed Series A stage. And we only invest in companies that do something good for society, but do so in a purely commercial business model. And the planet side is energy transition, circular economy, and food and ag. I guess the reason I started investing into energy because I used to be an energy entrepreneur, so that seemed to be a field that I should know a little bit about. And the reason I started in that is that I think, and the more I've worked in it, and I've been doing this for 20 years now, is that technology will drive towards a cleaner future, but we'll only get there if it also becomes cheaper. And the combination of sort of economic benefit and societal benefit is, I think, a combination that is a winning one for the longer term future. So that's the reason to start with it. And why early stage? Because I think we need to change systems, and that change starts at an early stage of innovation, and that's the part that I'd like to support most.
Cool. Thank you for joining. Now, to really bring a broad perspective today, we have Helmer as our early stage investor, and we have Hein as our later stage investor. And Hein, I'd also love to hear from you. Who are you? Why climate tech? And what does Gilde Climate invest into?
Of course. Thank you. Hein Ploegmakers. I'm a partner at Gilde Climate Solutions. This is a new fund strategy for Gilde, focused on so-called lower and mid-market companies. I'll explain that a bit later. And companies specifically that make a positive climate impact. So I've been a private equity transactor almost my entire professional life. For the longest time, almost 25 years, I've been with Rivean Capital, that used to be Gilde Buyout Partners. And that is a so-called generalist private equity fund, meaning they can invest in a much broader spectrum of businesses. And I'm excited about this space and a specialty strategy, because I feel we're at a time where no longer the notion of climate impact having to compromise on return is still there. So well, we'll dive into that later. The specialty strategy here for Gilde Climate Impact should give us a good chance of winning the right climate deals over, let's say, other generalist funds, and so we're there to prove that out.
I love it. So we have two investors with us who really believe that not only can you have impact investing in climate, but you can also make money. So I'm very keen to dive in deeper. Before that, going over to Daan Walter, who will share a few slides of a very extensive deck that he just published with the think tank he works at, Ember. But before we dive in, Daan, could you briefly explain what you do and why you do it?
Yeah, super. Hi all. I'm Daan Walter. Thank you for having me on today, Lisa. So background, physics background, worked for the longest time as a strategy consultant at McKinsey, at the Rocky Mountain Institute, all focusing on energy strategy. Currently with Ember Energy. It's a global nonprofit where we track the rapid progress of new energy technologies around the world. And we publish quite a few pieces every year on just tracking how fast things go, and larger narrative pieces like the report that we published 2 years ago on the electrotech revolution. I'm based out of New York myself. The team I wrote this with is a little bit all over the world, in London and in Asia. Yeah, why do we do what we do? I think that the energy transition is one of the most misunderstood and largest market opportunities, I think, that we've seen maybe since the digital revolution and the internet, and people seem to be blind to it. And we'll get back to this in the presentation a little bit, but I think that it's one of the biggest blind spots, especially in the West at the moment. And we just need to wake up a little bit. So we're just excited to just get the information out there. Often the data does enough of the talking of how fast this is going. And we're just excited to get that story out there, because I think once that clicks, once more people start talking about it, like Helmer and Hein here, I think the faster we actually start realizing that this is not just very exciting in terms of the climate damage that we can avoid, but very exciting in terms of the money that we can make.
Thank you for that. And we couldn't agree more here at Carbon Equity. I think, at least speaking for myself and us, what the electrotech revolution decks have really done is, one, reiterate what we already believed, which is this transition is happening and it's moving in one direction. You can make money investing in it, but it also helped us wake up, in a sense that we tend to talk about the energy transition as this luxury that will help us save the climate, whereas I keep saying it. Last year, there was a slide in the deck. It's not in the deck this year, but the title was "You snooze, you lose." And for me, that's still the key message that we should be taking away from this deck, next to how exciting it all is, just how important and fundamental this is to the global shift that is already happening. But Daan, please take us away.
Yes, let me share some slides. So the entire slide deck is, of course, 100 and something pages, which I will definitely not try to go through in its entirety. I just have a selection of pages to talk through. So first, let's start. Why did we decide to write this report? It's first and foremost because we feel that the conversation on energy today is dominated in a gridlock between two camps. On the one hand, there is the incumbent energy view, the fossil energy view, that is centered on fossil fuels, slow change, business as usual, small government, incumbents actually taking the lead into a very slowly developing energy system into the future. On the other hand, we have the climate view, which is a bit of a technocratic view that looks at the energy sector as a problem to be solved. It's centered on emissions to be avoided, policy targets to be met, and all the moral obligation to fix climate change. And these two camps, I think most people dialing in will agree, this is constantly what you see in the newspapers, what you see in the news. These are the two camps that are played out against each other. We don't believe that that's actually the right view on energy today. We propose a third view, which we call the electrotech view, which is centered on rapid growth, it's centered on innovation, and it's centered on the economic opportunity of the energy system, and particularly that new energy provides. And as we'll go into in a few pages as well, we propose this new view because we find it has a much better explanatory power of what is happening in the world today. Neither the incumbent energy view nor the climate view actually help us understand what is happening in energy today. And we'll go into that a little bit in this pitch as well. But first, what is this? What is electrotech? What is this revolution? So the electrotech view looks at the energy system through the lens of a technology revolution, where we just have superior technologies on the supply side, technologies like wind and solar, on the demand side, technologies like electric vehicles and heat pumps, and on the connection sides, new ways to connect supply and demand with battery storage and new, for instance, high voltage grids and other flex tech and grid tech solutions. And when you look at all of these new exciting energy technologies, they have one thing in common, and that's they are all sort of, their magnetic center is the electron of all of these, right? This is all electric technology. And so this is a technology revolution where we actually graduate from burning fossil fuels into an electricity-centric system. It is a mistake to think that this happened, that these new energy technologies came together maybe sort of post-Kyoto, maybe post-Paris Agreement as a response to climate concerns. It's been a long time coming. Many of these technologies have been developing for decades, some as much as over a century long of development. You know, it's our parents, our grandparents, and our great-grandparents that have been working on these technologies to make them more efficient, get the cost down for decade after decade. And we're living now in this very special moment where just over the last couple of years, we've seen wind and solar becoming cost competitive with fossil fuels after decades of cost innovation. We've seen batteries becoming cheap enough to actually take up balancing services from gas peakers. Again, decades of innovation. We've seen electric vehicles becoming cost competitive, even on sticker price now, with diesel and gasoline cars. We've seen cold climate heat pumps coming in and actually becoming competitive to heat homes in the coldest climate in the world with heat pumps. This all happened, all these events over the last 5 years. And this is this great convergence that we're seeing now today. We have a century of evolution in these technologies that are now coming together in a decade of revolution. And if we look at the last couple of decades, another thing that we need to recognize is that it's been quite clear for us to see how climate policies have helped electrotech grow. One thing I think that's much less appreciated is to what extent electrotech is actually the child of digital tech. If I take a solar panel apart and a laptop apart and a gas power plant apart, it becomes very clear that the components that are underlying electrotech are much more like digital tech than there are like old energy tech. So it's really what we're seeing is also the momentum of the digital tech revolution is kind of inherited into electrotech. And that's part of this rapid rollout that we're seeing. And it's not just the components as we show here on screen, it's also the people. Like think for instance of a BYD. BYD used to be the old iPad manufacturer for Apple. And now of course what they do is just put wheels underneath the iPad and call it a car, and hence the BYD success. And this is a general trend I think that you see happening in the industry. The people behind electrotech, this is the Asian side of big tech. This is not California big tech, but this is Shanghai and Guangdong big tech. These are companies and organizations that are planning for rapid disruption because they have experience with doing that before. And that's exactly what we're seeing when we're looking at, for instance, manufacturing capacity. compared to an IEA net zero outlook. The amount of capacity of solar manufacturing and battery manufacturing, primarily in China, that's being built is more than twice as much as we need for a net zero outlook. These are industrialists that are building for a rapid disruption because they've done it before, they've seen it before, and they're just applying the same playbook, what they did to information technology, now to energy technology. The ceiling keeps getting higher. So one of the exciting things of this convergence over the last decade is how much more we can actually electrify today. If we roll back the clock and would have this webinar in the year 2000, we would kind of, look at this picture on the left and say like, oh, you have some exciting, promising sectors where we see electrification becoming possible, but it's still kind of hard and not really competitive. Now, 25 years later, today, we can say that about 75% of the global energy system can actually be electrified. And of course, with wind and solar, be supplied with renewable electrons. And this is a transformational realization because when 100 years ago, equipment and conveyor belts and lighting could be electrified, within 10, 15 years, very rapidly, the world moved towards this electrified system. The same we're now, so of course, starting to see with electric vehicles and these other heating technologies. It's now competitive to go electric. So what is driving this? I have now looked at like the origins of electrotech. Let's spend a little bit of time and think about what's actually driving this transition, because it's wrong in this moment to think that it's really climate policy that is in the driver's seat of electrotech. The drivers of this transition are actually much more fundamental. They're the drivers of physics, economics, and geopolitics. First, physics. Simply put, electrotech is 3 times more efficient than fossil fuels. Fossil fuels, about 2/3 of energy you put into our energy system is lost at the moment. That holds for the supply side, but also on the demand side. Fossil fuels, because of their thermodynamic fuel, right? So you need to burn stuff to get something out of it. And that's just inherently a very inefficient process. Electrotech is 3 times more efficient. Then on economics. Very simply put, learning beats digging. Electrotech gets cheaper as we scale. Fossil fuels get more expensive. Because electrotech we make in factories, and it abides by what you call Wright's law. As you scale up more production, you learn certain things and you learn better ways of doing things. And so costs start declining. And that's exactly what we see over the past 50 years. Solar panel prices dropped by orders of magnitude as we started to understand and scale the supply chain of solar. On the other hand, we look at the other side here on the right, and we have 125 years of oil prices. And, by and large, not an order of magnitude change. It's just some ups and downs. Of course, we get the cartel forming and so a swing up in the 70s. But by and large, fossil prices do not decline because the more you need, the deeper you need to dig and the more expensive it gets. And so at some point, you get the crossover point between this technology and a commodity. And that has just happened. The third driver, of course, is geopolitics. There are fossil import dependency is very widespread in the world. Specifically now, assuming most people on this call are from Europe, this should really scare us as Europeans. Look at the red around Europe. 50 countries, many of them, actually most of them in Europe, import more than half of their primary energy as fossil fuels. This is a widespread dependency that, of course, in the modern world with deglobalization is getting increasingly scary. Every country in the world has enough renewables available to them to supply their own energy demand, at least by a factor 10 more, some countries as much as a factor 1,000 more. So as these countries are looking for alternatives to become energy independent, logically they will arrive with renewables, and logically they'll arrive at electrification to put those new electrons to work to power the economy. And electrotech this way offers a path to more permanent energy security. If we run through this space from the left to the right, today we have a system where we need continuous imports to actually keep our system running, not just deploying new tech, but also to run the cars, heat the homes, run the factories. As we move towards electrotech, you might still have a dependency on importing new technology, but as long as the sun shines and the wind blows, you can actually keep running your system without much import needed at all. And of course, just to highlight that, there's a third stage to this, which of course, once you implement circularity on top, you get full energy independence, as you can also remanufacture the technologies that come out of your system and you can put them back in. And that really should be our target in the long term. We believe that China has been onto these fundamental drivers and this fundamental shift for the better part of a decade already. which is why about 2 years ago, we coined this term, China as the first major electro-state. They're using electrotech as a new tool for power to domestically get more competitive, but also internationally to use it through, for instance, exports and trade deals to actually get an advantage over other geopolitical competitors. And so we're seeing across the board, whether it's inventing new technology, producing it or deploying it, China running away with the game. And this is happening to such an extent that emerging markets actually at the moment are leapfrogging, powered by imports from China. 63% of emerging markets have overtaken the United States in terms of solar penetration. 25% of emerging markets have overtaken the United States in terms of electrification, share of energy from electricity. Just go back to that original framing of the two camps that we hear in the news constantly, the fossil gradualist and the climate view. Neither of these views can make any sense of what we see on this page here. The fossil view would say, I mean, surely electrotech is expensive and a toy for the rich, but why are the poorest countries in the world actually going really fast? The climate view would say none of these countries here have actually good NDCs or good climate plans. So what is happening here? Neither view really makes sense. And this is why we really believe that the electrotech view is necessary to understand what is happening in the world today. So what is happening today then? This is the decisive decade. The alternative title, as Lisa put it, is you snooze, you lose. That is what the decade that we're in now right in the middle of. The manufacturing capacity is being built, as we've seen. S-curves are starting to hit their steepest point. Solar will go from fast to faster uptake. Electrotech is just simply becoming too cheap to resist. Today, we're talking about competitiveness. Tomorrow, we'll be talking about irresistibility of this cost. It just becomes incredibly cheap. And then, so of course, also, this is the decade where fossil fuel demand will start entering its terminal decline. And it will become very clear for investors and the capital markets that the future only lies in one direction, and that is the direction of electrotech. Automotive here is a warning sign and good for us to look at as an example of what will happen to one industry after another. Powered with electric vehicles, China went from a small and marginal car exporter to the largest car exporter by a mile in the world over just something like 4 or 5 years, right? From fifth to first from 2020 to today, putting major economies and major parts of major economies at risk doing so. This is the disruptive power of electrotech that we need to realize. If we don't surf the wave, we'll drown in it. So what to do then? How to gauge, in this time of ultimate confusion, I would say, how to gauge new technologies on whether or not they'll be successful. We have a very, very simple framework that we like to put on new technologies. And that's just simply looking at these fundamental drivers and asking, does it actually make the energy system more efficient? Is it small modular so it can be pre-manufactured and it benefits from learning rates? Does it actually enhance the independence and the security of its user? If the answer is yes across the board, you probably have a winning technology. If the answer is no on all three, you probably have a losing technology. And everything in between becomes that gray zone where we're not quite sure. Finally, last point, very important, especially for a European audience, which I think we have mostly here, is we need to electrify. We've been doing incredibly well on this chart here, moving upwards, like building more wind and solar. We've been doing incredibly well. You can see the dots here in green. A lot of countries in Europe have accelerated their renewables. Very few have put those electrons to work to actually grow the economy in new ways. This is what differentiates China at the moment. This is why we call it a country that's building an electro-state and not just accelerating their renewable supply, because they're actually harvesting these new electrons from the fields with solar and wind, but they're actually putting it to use in new industrial sectors and in new transport and building segments. So to close off very quickly, for the first time in history now, we can now harness the exceptional power of the sun through electrotech. This has been a long time coming. After a century of evolution, electrotech is now coming together very rapidly and surging globally. It's not just driven by climate change. This is driven by the forces of physics, economics, and geopolitics, and would happen even if climate wasn't a concern. It will come faster and further than most people think. It will strand assets beyond just energy, and it will reshape global leadership. This is the decisive decade. And now it's up to us to decide whether we surf that electrotech wave or be dragged under. And I'll pause there.
Thank you, Dan. I think that will be an excellent lead up to the discussion. There was one question I think is worth covering now before we do so, which is you compare the price of solar panels to the cost of units of fossil fuels, which there we really see the shift. But something that people often hear is that electricity prices go up as systems have more renewable energy on them. How would you answer that?
So, I mean, there are different layers to this question. I think the simplest way to look at it is the cost parity between wind and solar and fossil fuels only happened very recently, around 2019 globally. So all the renewables we built pre-2019, it's very obvious, of course, they raise system costs. So if you look at, for instance, Germany, obviously the power price and the system cost of power went up because Germany kind of saw this as their moonshot, built a lot of renewables, saw it as an obligation for the country. And yes, that raised system prices. Since then, the new renewables coming online are actually system cost lowering. And we know this because we model it, but we also know it because we actually see that in wholesale prices and other analyses. So the tricky thing, the moment that we're in right now, is we built about half of the renewables that we have in the world today were built pre-2019. The other half were built post-2019. So about half of the renewable capacity is indeed increasing system cost. The other half is lowering system cost. And so roughly we're break even at the moment, by and large. It's only from here on out that we will actually see structural improvements to the system cost price with renewables. And so this is the tricky moment that we're in. And I think why we are rightfully having some doubts at the moment, like, is this actually happening? We've been cost competitive now since 2019. But we're still very much of the belief that this is just something that we just need to rinse through the old stock of renewables and renew them with new renewables, and then it'll be a lot cheaper.
All right, so we'll have to wait and see to see the proof there, or to feel the proof is probably a better way of putting it. For now, I'd love to go over to our other panelists. Hein, could you give us your initial reaction? Like, what from the slides that Dan presented is something you already knew and is already kind of part of how you're looking at the energy transition? And maybe what was new or striking to you?
I think it very much resonates, i.e. the growth that is exciting, obviously the discomfort to a certain degree in that, well, a lot's going on, not exactly clear how this will pan out. And then I wouldn't call it a surprise, but the fact that China is definitely taking this major advantage over the rest of the world in how they do it. The disruptive character, yes, you see it. You see it happen. The car industry is indeed the best example, and what that causes, how this will change entire industries. That's definitely massive. So yeah, to me, it's definitely a great study where that's being laid down here.
Cool. And just to challenge, like, or I'm just curious, like, are there any things in there where you're like, I'm not sure, or I've seen something to the contrary?
Nothing springs to mind right now.
Let's see, maybe later in the conversation if something
Yeah.
pops up. For you, Helmer, I'd also love to hear your view. Kind of what did you already know, and what surprised you looking at these slides?
It's a test of whether I know the content of 22 slides. I think, I keep being surprised, as Hein is saying, at, how the graphs look for China and how they not look for the rest of the world. So I try not to be sort of scared of that, but try to think of what opportunity does it actually bring to us. If they're investing all these trillions into technologies that we need, and they bring down those costs, that's actually a great thing, right? So I think the challenge for us is to see more on, if the assumptions on all the economics of these technologies are right, what does it actually mean in the application? Because that's where the opportunity lies. If you have very cheap electrons or very cheap machines that can turn electrons into the products and services that we actually need, such as heat or cooling or movement or whatever, then those are the technologies I think that we should be looking at, the application of it and the transportation of it and the buffering of all of that. And those are then the sectors that become very relevant if this electronic world of Daan becomes a full-scale reality.
Super interesting. And is that also like a perspective you're already applying today in how you're looking at companies and where you decide to invest?
Yeah, I think so. We've kind of, I guess everybody has given up on trying to produce solar panels, although not everybody. There are some brave people still doing that. But batteries followed, electrolyzers were next, EVs are there already. So all those production things, I think, the people on that side of the earth are just much better at going for it at very large scale, right? Pouring billions into it ahead of any demand. So that's wonderful. But I think, the opportunities here are much more about the mess that exists between sort of the volatile generation or the supply of through wind and solar, the electrification demand on the other side. The mess that happens in between, I think, is a great opportunity, right? That's where the grid congestion comes, the demand response, the flexibility, the storage, the management of all these things to make them smart and to reduce cost while being smart. I think that's an element that's super exciting for us. And there's another parts where electrification, I think, Daan, is still hard to realize, which is, for instance, in high temperature industrial heat. Anything above 200 degrees, heat pumps, bit challenging. But there's a lot of energy that goes into industrial processes that need these high temperature. So I don't see electrification happening there within like 5 or 10 years, and I hope I'll be wrong. But sort of the net present value of a CO2 emission avoidance today it's much higher than it is in 20 years from now, when we will have nuclear fusion. That is a part that I also think it might be a non-electric revolution required as well.
Yeah. Oh, there's so much to build on there. I'm going to take it to Dan first and get your view on how far away is electrifying industrial heat?
So technically not that far, right? So we know that there are technological solutions to actually get into higher, like of course anything below 200 heat pumps, more or less a slam dunk. I mean, obviously there are specific applications where other direct heating is more competitive. High temperature heat, we know. I mean, you can make plasma, so you can go incredibly high temperature with electricity. So it's not about that it technically isn't possible. It's more that the economics are harder because electricity is just more expensive at the moment than gas. I mean, this is also a policy decision, a taxation decision, etc. But it's also just the reality of the energy system today. It will remain hard, and I agree with Helmer's assessment here. For the next 5 to 10 years, I do not see that these sectors will make great strides. Of course, we would want that from a climate perspective, but realistically, from an economic perspective, this will not have these improving economics over the next couple of decades. So I think this is one of those last mile problems that part of this 25% of the energy system where we do not know yet how to decarbonize, or rather we do not know yet how to do we know the technical part, but we just don't know the business model part of that yet. I think we will figure it out. As with many of these solutions, I expect that current technologies will develop faster and in more exciting directions than we can expect. So my bet still remains on electrification in these sectors, but not electrification over the next 5 to 10 years.
All right, then let's return to the 75% that is already in the money. Helmer, I love the view that you presented about the mess in between and all the opportunity that brings. Hein, is that something you recognize? And maybe more broadly, also very curious, Dan said there's like innovation happening on production side, on electrification side, and on the mess in between. Where are you focusing most?
Yeah, good question. As a private equity investor, we're certainly not interested, in revolution. Revolution comes with binary risk. It's going to be big, or you can go home. Different ball game. So as soon as things become more predictable, then we're in. And this is therefore I don't need to be an expert like Dan, like Helmer, in those super exciting technologies, because before they become mature and scaled, everyone's becoming an expert to a certain degree. So the opportunity set for us as a private equity fund right now is probably largest on say the demand side, where, for instance, we see a lot of service companies, service-like companies focusing on installation, maintenance, engineering, design. Again, the application side of things. We wouldn't be investing in that last Mohican in Dutch solar. How courageous they are. That's not for us. So we're talking about businesses, for instance, that do maintenance for wind parks, or the built environment, where renovation companies are working for housing cooperatives to make millions of homes more energy efficient. So this is the real world, right? This is evolution. Still, that comes with high growth rates, but again, it's not revolution.
Yeah.
Is that an answer at all?
Yes, absolutely. At the same time, there is a revolution happening, or at least according to Daan and the Ember perspective. Have you noticed that revolution in the investment universe you have? Are you looking at different opportunities versus 5 or 10 years ago?
For sure. I mean, with businesses coming to scale, scale is happening scale maturity is what brings predictability, right? And we need predictability in a business model that produces relatively stable cash flows so we can leverage businesses. So yes, we're seeing the opportunity set widen in the climate space. They're not necessarily deals that I wouldn't have looked at in my previous life as a generalist investor, right? So it's difficult for me to answer. I would have looked at the same deal 10 years ago. There are simply more of those companies coming out of the harbor, which are indeed of a size that they're investable, that they can be structured as a private equity deal. So they're becoming mature.
Understood. Helmer, have you kind of the shift that Daan described with the like, okay, 25 years ago, we thought we could electrify 25% of the energy system. Today, that's 75%. Is that something you've noticed in the universe that you're looking at?
I think the short answer would be yes, because, you know, coming back to industrial heat, arguably if wind and solar electricity is so cheap at certain times of the day, you can start using, let me introduce another controversial term here, hydrogen, as a storage or as a carrier of energy, which you could use for industrial heat. So yes, there's a lot going on. I wouldn't expect to have invested in companies that run on pure software SaaS business models servicing tens of thousands of homes just with intelligence to reduce their energy bills. I think that's an exciting move, right? That sort of the SaaS model is something that resonates really well with investors, but it actually reduces bills and it reduces emissions. So that combination was one that 10 years back I did not expect to have happened at such large scale and so quickly as it has.
Understood. We're getting quite a few questions on that other 25%, the hard to abate sectors. So I thought maybe combine it with a question that I had, which is what technologies or sectors are you seeing momentum build and are you kind of waiting for to become investable? And I'll leave it up to Daan, Hein, Helmer, all three of you to whoever wants to jump first. Or none of you.
Far be it from me to talk about investability in front of Helmer and Hein.
Maybe on the other hand, then Dan, I would be very curious, kind of like where are you seeing momentum build and where do you think we're underestimating the potential of certain technologies or trends?
I actually think the comment that we just got in the chat from Alexis is actually a really good one. There are some interesting things happening with the Rondo Energies, the Antoras on higher temperature heat. They're in early phase, and I think they need to really prove out. But those are kind of things I'm quite excited about. Similar with lower temperature, like sort of electrified steel in a way, right? The sublime process for cement. again, I am not deep enough on these technologies to say I know they will work and they're excited, but they have this sort of I would call it like the germ of electrotech in them, right? They have this thing of like they can be small and modular, scalable. They increase security of people. So I'm excited about them because I think that if they technologically work and economically can indeed make the case well, they do have that germ to grow really fast and be quite powerful. And so probably if we meet again in another 10 years in a webinar like this, we're probably going to talk about how we were surprised by technologies, I think, coming from that direction, sort of the electrochemical way of industrial development.
Yeah, I think another part, and I'm going to take your suggestion, probably Lisa, put on our website, maybe we invest in the mess in the middle. But I think, probably a big push would be if we actually have a blackout, which hasn't happened in a very long time in our region. It's more common in the US, I think, but it is soon to happen, right? 2/3 of our country, you cannot get a commercial grid connection anymore because it's just clogged. There's like 30,000 job openings to help unclog the grid. And that is something, if we continue to push down the production side of electricity, all those electrons need to go to their destination where they can put to use. And I think in that part, there is an opportunity for like high-tech, large-scale infrastructure, just putting more copper in the ground or high voltage cables or whatever. But there's also the storage and the software component. I mean, a lot of these things can be solved through software, just being smarter about how we do things. And those are the sectors where I think in the next 5 years, that's where a lot is going to happen.
Got it.
If I can jump in on that, Helmer, because you mentioned it 2-3 times, and I think it's a really fundamental point that I think we misunderstand who actually makes money in these large technology revolutions. Like if we would make charts of where iPhones and iPads were made and just smartphones in general were made over the IT revolution, that would not be a Western story. Yet who walked away with most of the money? It's big tech in America and San Francisco. Why? Because they specialized in the mess in the middle. The mess in the middle is software. The mess in the middle is satellites. The mess in the middle is actually where it gets exciting. By now, anyone in a way can make solar panels. That's not very hard. Making them competitive is just a scaling thing, but making it smart and making homes talk to each other, making, virtual power plants, that's really where the big value add sits today. So I still have great hopes that the West, without per se having a manufacturing boom here, can still have a huge economic boom by just piggybacking, just like with the IT revolution, of producers in China that are making 1-2% margins on their solar panels, so we can sell software with 20, 30, 40% margins. That's a much better business. And I think we've done it before with the IT revolution and made a lot of money. And I think we can do it again.
Great pitch to investors. Helmer and Hein, is this something you recognize?
I recognize it, and it's right, but these still are, to a certain degree, to me, they're technology bets. I'm not sure if by that I'd be Helmer, if you're don't get me wrong, but that's the venture capital side of things, right? So what comes with this as well is a massive runway for, as I said earlier, plain vanilla service businesses, technically skilled people who can assist in implementing on the ground the energy transition.
Yeah.
And that's going to keep us busy for many, many years to come. So one of the big problems for that grid congestion today, like you said, Helmer, is that we simply lack the technical hands to get it done. And yes, there'll be technology solutions, but there is also that element here. And that's, again, something I can relate to as a service business model is pretty simple to understand, right?
Yeah. And you're saying there's plenty of work to be done. Does that mean there's plenty of investment opportunities for you?
I would say yes.
Yeah.
And I think you're right. I mean, the words you've used before, Hein, is predictability. You don't want to get into a business where predictability is low. The say-do ratio of any management team needs to be spot on, right? So I think, as we implement those new technologies, I think that's the right word to use, right? It's implementing the technologies into sustainable, stable business models. For instance, there's a lot of startups that do electronic management systems, right? Or energy management systems. Once they get above like 50 or 100,000 customers, the predictability of what they bring in terms of customer lifetime value and acquisition costs that go through that will be very clear. So I think bringing those technologies to those kind of sizes where it becomes predictable, and then you guys can pump in like anything with 2 or 3 extra zeros than we would do, and bring it from 100,000 to tens of millions of customers. I think that's the job that we need to do.
Great. There's actually, it brings me to an interesting question in the chat, which is a little bit around like, how do we make sure that the handover between the early stage and the late stage investors runs smoothly? The question is specifically around valuations. How do we make sure those stack up? But more broadly, I'd be happy to hear from either of you, like, how do we make sure the early stage companies get to the maturity and are also then easy to invest in for a company or fund like you, Hein?
Great question. Helmer?
Tell me what your what your conditions are, Hein. We'll bring the companies there.
This is I think we're coming off maybe different planets. In the end, making those deals work, yes, it happens. Clearly, structuring this in a private equity way doesn't probably live up to stock market expectations, let's put it that way. So for really fast growth, I think people like Helmer will still be looking at stock markets to support any further advancing at valuation levels, which for those companies are probably going to be more attractive. But there will be convergence, no doubt. There will be convergence.
Other type of convergence. Yeah, I think we've been just invested alongside a big pension fund with a team that works in infrastructure, right? So they've all of a sudden had to sort of work with a company that is pre-revenue, which is very strange. So that kind of brings me to a lot of lessons how we can push it through to the bigger investor, because I do think it's important. I don't think we can live in a viable ecosystem where the only way to make this right work is to go public. I think the number of companies that are fit to become public in a period of 5 to 10 years is just too small. So we have to be able to also push this on to private equity. And I think the valuation part of venture capital is very much around growth, right? Users, revenues, and then you raise money for 18 to 24 months. You make sure you double your valuation and you don't dilute more than 20 to 30% in every round, right? And if you listen to that, that is not actually the basis of value creation of a company. Those are just metrics around which VC is structured. So as you go through those rounds, I think you need to work as a company on a scenario where you know that your valuation of those multiple rounds end up in a valuation bracket that will be acceptable for Hein. And Hein thinks in EBITDA multiples or EBIT multiples, right? And he goes, well, if it's not growing very fast, I can do maybe 6 or 8. And if it's like through the roof and profitable, I can maybe go into double digits. And that's it. So if you're working on a hardware company or an installation company of hardware, you've got to be able to figure out a way that at the end of the road, once you've become profitable, you can still generate a good exit for your shareholders and for yourself at those exit multiples. And if you don't calculate that route, you're going to get stuck somewhere.
Do you agree, Hein?
Yeah, definitely. This is the best answer, and I like the approach. And I'm not sure if it's going to work every time, but certainly this you should apply as a VC investor to land your company in the private equity zone.
Great. There's one more.
And you can do it, right? So Dan mentioned the 20, 30, 40% margins. Some of these technology companies can make. And then all of a sudden, those EBITDA multiples turn into great revenue multiples as well. I don't have to explain that.
One more angle I'd love to cover before we wrap is the geopolitical one, right? So Dan said there's three drivers. We're talking physics, economics, and geopolitics. I'd love to hear, and Helmer, from you. Are you noticing this in the companies you look at, and how so, right? And I think two that are especially relevant. One is the increased independence, and the other is the decreased volatility. Is it either of those, or is it another one?
Those are a lot of words together, which I'm
Sorry.
struggling with. No, I mean, clearly what is happening in the US with import tariffs is, of course, super scary.
Yeah.
Right? If from one day to another, the cost price of your product that you're purchasing from elsewhere, which is a core of your service or product that you're delivering, doubles in price, that obviously is killing, right? What else is happening in the US? You know, the tax equity for solar lease systems is being killed. Probably 99% of all solar installations in the US are leased, which are through lease vehicles which have tax equity benefits. So if that's drying up, that kills the business completely. And I guess the same happens here, right? There was one sentence in the agreement that the political parties in our country signed, what's it called, in regeerakkoord, which said we plan to take out the subsidies on heat pumps. Right? There was a compulsory law that you have to go hybrid in 27. We plan to take out that law, and just that one sentence can cause a 30 to 40% downfall in a market. So, yeah, that is a scary part if you do sort of binary changes at short notice. You know, but the underlying thing for regulation, I think, in Europe is the ETS system or the Green Deal, which has a much longer term view and is gradual, right? It becomes bigger and bigger every year. So it's a gradual change where industry is going to adopt to. I think that would be my call to action to anyone who's in policy making. Do it long term and do it gradual and make it predictable, just like Hein likes it. I think companies will like that as well. You've got to make it predictable so we can adapt. So you can pick the technologies that will fit within that regulatory framework and make it work, and don't overhaul it overnight.
Yep. Absolutely. From an investment perspective, there is also a bit of a blessing in disguise, maybe, in that, of course, these trends, policy changes haven't helped. At the same time, it made for, let's call it an ultimate stress test. And now if you find companies that can thrive and survive under these conditions, they are probably going to be the winners if they can adapt. And in terms of valuation, and this is maybe also for the listeners, many of those companies were on cloud 9 3 years ago, and those valuations now also have come back to more normal levels. So they're making for a better deal environment, I think, at least from my perspective. But yeah, completely agree with you, Helmer. Predictability, stability, long-term choices and vision, that's what drives a better investment climate.
Yeah. At the same time, we are. I'm moving to a question from the Q&A, which is policy has already shifted, and more fundamentally, Dan, how do you think the energy transition what will change if policy support continues to weaken further?
More bottlenecks, and more bottlenecks means more companies and startups and innovators being able to make a lot of money, because the fundamentals are in favor of electrotech. Like the solar panel will remain cheap and will get us cheap power. Then there's I think I like Helmer that we're claiming this, the mess in between part, but that's the mess in between will become even messier, and there will be even larger opportunities there to make a lot of money. And then similar on the demand side, the EVs and the heat pumps, they will keep being cheaper. So I think it's just opportunity, and like it's to some extent right now, this transition has a life of its own, and it will happen automatically by itself. The question now is how fast you go, and the question now is how do I, as a country, benefit from it? And Policy should be here now to provide that sort of predictability, as Hein and Helmer puts it, but also to provide that smooth transition from our current way of thinking and our current systems into this electrotech system. And the countries that will do that best, countries that have done that best, are China, for instance, with the 5-year plans. That is ultimate predictability. Talk to someone in China and say, like, what is your forecast for 2030? And say, like, well, this is what the government says. That's my forecast. There is no other pathway than that. That's the
Daan froze.
this gliding path from one into another. I think another component, by the way, to add though, I do have to say, I think there is a predictability component that we need to focus on geopolitically. I think there's also a willingness to adapt in it, a willingness to change the way that we're doing things. China didn't get where they are today by just doing what they used to do over the past 100 years better. They got here to actually say, what do other countries have to offer that we can learn from them? And we should stop being so sort of Western arrogant and look at the rest of the world as people catching up with our way of living. When we talk about electrotech, it's now up to us to catch up with how other countries are doing. So I would say invite Chinese factories in, but if and only if you can look over their shoulder and manufacture with them. Invite technology in, but if and only if they run on European software, not Chinese software. Make sure that you finance projects in the global south, but if and only if it goes in your way, not in the Chinese way. This is the way how you can make actually a lot of money. But that requires us first to just realize that we might not be all that in Europe when it comes to energy, and we might just be, fast followers rather than the leaders in this transition right now.
Yeah, is this something you echo, Hen?
No, absolutely. I mean, in the end, macro views are great. I'm super interested to listen to them, but you have to accept them as they are, as they unfold, adapt, and work with the micro, i.e. select the best businesses, help them grow. And these will be led by adaptive entrepreneurs. Sure, in your due diligence, you'll be looking to mitigate those critical dependencies. So not be depending on one certain subsidy, or just like you don't want to be depending on one key customer. So it's part of your business. And yeah, that's how we should be finding the right deals.
Thank you for that.
But I agree with the arbitrage opportunity that it brings that you've explained, Dan. It's just getting bigger.
Yeah, could you give a bit more color, Hein? What do you mean there?
Well, that mess in the middle, as that big pool, that's getting bigger. So you'll see more opportunity, especially I think in the early stages, for people trying to figure out ways to arbitrage on those problems, because the problems will still be there, and the development continues.
Yeah, exactly. The energy transition. We're getting more renewables on the grid. We're getting more EVs on the grid.
Yeah.
The grid is not ready for what is coming, and so everything around there. We're almost at time. I'd love to hear as a final thought. We presented in this webinar, Dan presented a very different view on the energy transition, right? Where sure, for the climate, it's great that this is happening, but there are secular drivers that are propelling it forward because it's better tech. Looking at the people that decide to invest with you, Helmer and Hein, is this what's driving them when they look at your funds, or are they primarily with you for the climate impact, or are you seeing this idea of the energy transition is a very big opportunity reverberating with your investors?
For us, I think it's both, right? People come to us because they see that we want to bring positive change in society. And they come to us because they think it's a good investment opportunity in terms of pure financial return. And I think that is, that fits completely into Daan's story, where cost price of electric technologies are coming down, and they can be powered through zero emission sources, right? So that is the one thing that you need to look at is, as we select our investments, do we see that these companies scale to a size where can you really reduce massive amounts of emissions, and can they do so at cost parity with the current system, or at the current system, or the system that they have to compete with in the future? And if you can't see a cost parity at scale, it doesn't make sense. And mind you, cost parity needs to be free from any subsidies. Right, that's the way to go, because then you're just building a company. Then you don't have to be climate obsessed or anything. Then you're just building a company that's delivering a better product. And if it then also resolves the emission problems, then that's great. But you have to have that combination.
Understood. Hein, what's it like for your investors?
Yeah, I can only echo that. It's the old paradigm to think that there should be trade-off between climate impact and return. It's the notion that many people have when they look at climate impact investing. I don't think that's true anymore, and a lot of that is what's in Daan's paper. Is underpinning that. So the new paradigm is this should go hand in hand. So you can have a moral cause and still make good money.
Thank you. I couldn't agree more. I think it's an excellent message to land on. Hein, Helmer, Daan, thank you so much for joining. Audience, thank you so much for joining, and have a great evening. Goodbye.
Thank you.
all.
Thanks. Bye.
Thanks. Bye.